Girish Kousgi, the MD and CEO at Canfin Homes, joins in on the show right now. Girish, hi, good morning. Good to have you on the show. There's been a good amount of fund interest in Canfin Homes recently. While your loan book growth has slowed in the recent quarters, the pandemic has also led to a rise in demand in homes, especially in Tier 2 as well as 3 cities. What are the trends that you're witnessing on ground right now? And where is it that you see pockets of heightened interest and activity?
Yeah, if you look at last couple of quarters, there has been degrowth in book. That is largely because of normal repayment, which happened during lockdown until the moratorium could get over. We resumed business only in last week of May, and it just started. So obviously, the business what we did was much less than the repayments, and therefore you will see book degrowing. However, in terms of uptake, last quarter from December onwards, we've seen good growth. In fact, our disbursement in December was equal to October and November both put together. So I think Jan was very good for us. Feb was all-time high, in Canfin's history, and March is going to be better than Feb. So definitely growth is back, and I don't think so. From this quarter onwards, we will see degrowth in book. There will be substantial growth in disbursements YOY and also in terms of book growth. And in terms of markets, definitely affordable space, I think demand is completely back. We're seeing that since last 4.5 to 5 months time. And in non-affordable, I think it's almost back about 90-odd%. Still, there is small pain here and there. Otherwise, this market is now robust. A lot of banks, both PSU and private, are focusing on mortgage. And therefore, you will see heightened activity in this space because other segments are yet to pick up, like corporate and SME. So this will go on for next 2 to 3 quarters. And I think at least coming year is going to be great for mortgage.
Great. Your loan growth has slowed to about 4% on a year-on-year basis. In the loan book growth front, the management, or rather, you had earlier indicated about a 17 to 18% growth in the upcoming quarters. Where is it that you're seeing incremental growth coming in from, in terms of, if you could give us some color, whether it's the salaried or the non-salaried, in terms of geographies?
One is, yes, this was some kind of guidance given before COVID. And if you look at last year, Q3, we did extremely well. Q4 was pretty good. And then lockdown started. And then we had 2 quarters, which was quite muted. And from again Q3 this year onwards, growth started showing up. And Q4 is going to be very good. So on a steady state, I think we should be able to grow at about 17 to 18%. And this would come from various quarters. One is in terms of geography. We are quite concentrated in South. We like South, and that's where we get about 70% of incremental business. In terms of profile, salaried is about 71. After COVID, I think that mix has slightly changed. It's skewed towards salary. This trend would be there for next year or so, and then of course it will be again back to 70 and 30, 70 salaried and self-employed 30. Also, what we have done is, because almost all the financial institutions since last 3 quarters are focusing on consumer within consumer secured within secured mortgage, because that is the easiest way of growing book. And within mortgage, I think there's a lot of balance transfer activity. And therefore, what we have done is we have changed a pricing strategy. Now, this is for to retain our existing customers and also to onboard good customers into our book. So this has seen significant growth. Now this will also ensure that next few quarters is going to be very high on growth.
Okay, give us a sense as to what the outlook is on the loan book, because a significant percentage of that comes from salaried individuals. What kind of consumer behavior trends are you picking up in both the salaried as well as the non-salaried individuals? And are you seeing stronger or higher credit demand?
In salary, definitely yes, because earlier our pricing was at least 125 to 150 bips higher than the best bank in the country, whereas now we are on par with the best bank and the best HFC in terms of pricing. So now a lot of new segments have opened up for us. For example, CAT-A corporates, CAT-A developers, now we can cater to in terms of retail business, which earlier we were not into. So now a lot of segments have opened up for CanFin. So this will ensure that the demand would be much more than what even before pre-COVID levels. So it's a new market for us. So definitely we see that this will give us lift in both disbursement growth as well as book growth.
Okay. Can you give us a sense as to how long your current capital is going to last in order to meet growth requirements for the company?
Both on capital adequacy and leverage, we are pretty comfortable. Capital adequacy is 24 and leverage is 7.3. So we are pretty comfortable. Now, having said that, we have aggressive growth plans for next 3 to 5 years time, and therefore we will raise capital very shortly.
Okay. Couple of other things wanted to get your perspective on as well. Now, while Canara Bank did call off the stake sale in CanFin Homes last year, any thoughts on that front? Will there still be a possibility of selling stake in CanFin Homes?
There's no update on that. We actually focus on our business and operations. So there's no update on that front.
Okay, fair enough. And in terms of provisions as well, on the asset quality front going forward and the kind of provisions that you see over FY22, if you could share a little bit more with us on that.
We have adequately provided for COVID. In fact, we hold on our books 73 crores for COVID and additional 13 crores, including the restructuring part. So totally we are holding about 86 crores, which is more than enough. And in fact, this quarter we'll be able to write it back depending on the regulations. So I don't see, any further provisioning would be required. On the other hand, we would be able to write it back.
Okay, fair enough. And Girish, in terms of margins as well, we have seen an improvement in the last few quarters, but now that there's also some pretty tough competition coming in from banks, they've reduced lending rates as well. 6.95% I think is also what's at the company, which is already 100 to 150 basis points less. What is the resulting impact on margins as you see it going forward?
Yeah, now we become a little aggressive on pricing, and therefore you will see margin contraction, but that will happen over a period of time. Having said that, our COF is lowest in the industry, and we'll also try and look for opportunity where we can try and improve our yields. So, but we will maintain NIM of 3 plus and spread of 2.4. Currently, NIM is around 4 and spread is about 2.9. So this will come down over a period of time, but you never know. After a couple of quarters, if things changes, we might look for opportunity of increasing the yield.